No matter what you trade, every single stock or crypto or Forex, everything that you can put on a chart goes through these four market stages. This is the market decoder system. In this video, I'm going to break down each stage, what to expect, what it looks like. And once you see this, you cannot unsee it. So let's go to my trading setup and let's break down these four stages. Here's how most people trade, right? Take a look. These are all articles and emails that I personally got, right? Trader turns $1,500 to 1 million in 3 years, or how I showed a 16-year-old how to turn 500 into 250,000. We've all seen ads like this either on Google, either on Facebook, or if you're a trader like me, you probably subscribe to a lot of different things and you get emails hit up all the time like turn this into this amount, all unrealistic expectations. These are just marketing gimmicks, guys. Real trading doesn't work like that. But in this video, you can learn that one pattern trading system that you can use and execute right away. So if you have the diamond hands or YOLO mentality, if that's your preferred trading approach, then just stop the video right now. This video is not for you. This video is for you if you want to actually learn how to trade professionally. If you have the approach of diamond hands or YOLO, like most people did with GameStop and AMC, then this video is not for you because that is gambling, and trading is very different to gambling or speculation. So let's dive in. Core principles of my strategy. Right? So in this, we're going to explore various different trading styles, right? You have to know the difference between day trading, swing trading, and long-term investing. But here's the best part. Once you learn this pattern that I'm going to share with you in about a minute, you're going to be able to do both day trading, swing trading, heck, even long-term investing, but just using the stage method. The only difference really going to be is as a day trader, you're going to be probably spotting this pattern on a 5-minute chart or a 15-minute chart. But if you're a swing trader, you're probably going to be looking at this pattern on a daily chart or a weekly chart. Now, if you're an investor, a long-term investor, you can use this exact same pattern on a weekly or a monthly chart, right? So applies across the board. No matter what your trading style is, just adjust the strategy on the right time frame, right? You got to find the style that is suitable to you. And for most beginners, I always tell them pick one style first. Don't try to master it all. Don't try to do day trade, swing trade, long-term all at once. When I started, I did mostly just swing trading. As I got consistently profitable in that, that's when I went into actually day trading. Right. And then obviously now I'm day trading and swing trading. So naturally, the next style was to add long-term investing. And I do the exact same style. But this pattern, again, I know I've teased you enough already, is going to teach you the basics of the market structure. And this is across the board. It's a fact, right? You can't change it. And I'll show you and you're going to learn that it's going to be the same thing. We're going to discover proven techniques for maximizing returns in trading, including risk management, technical analysis, and fundamental analysis. And then you have to take the strategy I'm going to teach you and customize it for your own needs. If you're somebody who's like, hey, I don't have time to sit in front of my computer all day. I don't want to watch stocks all day long. I have another job. I have another business. Then use what I'm going to teach you on a higher time frame, like a monthly chart, a weekly chart. If you're somebody who's like, I just don't have the patience to be a long-term investor. I want to just be in and out. Well, then use the same strategy in a 5-minute chart, okay? So let's dive in. So why learn the strategy in the first place, right? The reason for that is a lot of people end up investing based on fundamentals. Maybe it's an article they read online. Maybe somebody posted something on X or Reddit that they love this stock. Or maybe you're like, ooh, I've read some books and they say you can't go broke buying blue chip companies, right? You should always buy the names you know, the companies you use, and you should always look at fundamentals. But I'm going to tell you that fundamentals don't really mean anything in trading, right? Because markets move on momentum. Markets move on price action. They don't really move on fundamentals. In a long enough time frame, fundamentals could work out. But if you're buying a stock and it's going to take like 1 year for the fundamental analysis to play out, well, how are you going to trade that? Right? How are you going to trade based on a good balance sheet? Right? How do you know when to get in? How do you know when to get out? And that's a mistake people make. Do you remember Enron back in, they had 22,000 employees, one of the best companies in the world, probably the most secure blue chip stock. But why did it fail? If fundamentals were, great, because fundamentals are only great until they're not, until you find out the truth behind the scenes. So back in the day, you might also remember Bear Stearns, right? What a great company. You should all own stocks. What happened to them? Suddenly, they had great fundamentals until one day they did not, and they went bust. Remember, MCI and all these other companies, they don't exist anymore. And that's why I say don't invest on fundamentals. So here's a chart of the Citigroup, right? So everybody says Citigroup is such a great stock. You need to have it in your account. You need to own the stock in your portfolio. But if you did, well, you'd still be down after several years. Remember AIG, the insurance company? Look at their stock. If fundamentals were the only way to invest, then, well, all these companies would still be around. They'd still be doing a great job, but they're not. Even if you bought the stock and held it for many years, you're technically still down on your investment. So those were all great companies. But what about GameStop? So here's a chart of GameStop. So you take a look, GameStop lost over $1.3 billion, right, over the past like few years, but the stock went from $4 to 500. Why is that? Right? Every year they were losing more and more money. Why did the stock go up? If fundamentals were the only thing dictating the price of the stock, well then GameStop was not a great stock, but it still went up. Why? Because of momentum. And here's another chart, AMC, from the same era of the Reddit era, right? AMC. Look at their financial statement here. Every year they were losing more and more money every single year. In 2020, they lost, $4,589 million, where the stock went from like $0 a share almost to like $70 a share. So fundamentals were driving the stock. Why did AMC go up? Because fundamentals are not the only thing that moves the market. Here's a chart of Nvidia, right? So here's another example of why you should never listen to banks or these analysts or these research reports you read online, because Goldman Sachs went up like 300% in 3 months, and Goldman Sachs didn't say anything about the stock. But when it finally went up 300%, they upgraded the stock. It's like, this is a buy now, buy this stock, buy gold, buy Nvidia. Now, Nvidia, that was pretty much the high of Nvidia stock. Now, sure enough, Nvidia now came back in the year 2024, 2025, right? The stock finally came back, but it took 5 years for Nvidia stock to come back just to the price where Goldman Sachs upgraded it. So if you bought listening to Goldman Sachs research analysts and you bought the stock, you would have held it 5 years only for you to just break even on that stock. That's why you don't want to rely on fundamental analysis, or you don't want to rely on other people's opinions. You want to learn how to read the market decoder chart. And if you knew this pattern, the market decoder pattern, you would never have bought Nvidia there. In fact, you would have sold when Goldman Sachs was upgrading it, and when nobody else wanted it, that's where you'd be buying. And I'm going to show you how to use that in the next few slides. But before I do that, I really want to cement why we should not trade on news either. So we talked about not trading based on fundamentals. We talked about not trading based on what analysts are upgrading or downgrading, but we also should not trade based on news. Here's the chart of Q-Core. The stock had great news. So after this, Oppenheimer raised their target from $59 to $69. So technically this is good news, right? The stock got upgraded, but the stock dropped 60% after that news. Why is that? Technically, these news events are created as a way of other hedge funds and other people to get out. So they're getting the average person like you and I to buy the stock so they can just dump on you. So the stock had great news, but the stock still fell. VRTX. So VRTX is a biotech company, and they had a drug that had positive results in their phase 2 trial. So the stock was basically one step away from their drug getting approved. So that was technically really good news. But what happened? The stock dropped 14% on that news. That's why you don't want to trade based on news events. Let the chart guide you. So let's go into the strategy. The market stage method. Most stocks move in harmony with the market. Therefore, you have to understand the 4 market stages that every single chart goes through. I don't care if you trade Bitcoin. I don't trade if you care cryptocurrencies. I don't trade if you trade currencies or futures. I don't care if you trade options or anything. Anything that you can put on a chart will go through these 4 market stages. And it's important for you to recognize which stage your stock is in. So let's go with the 4 stages. Stage 1. This is typically a sideways base, right? This is called the accumulation phase, because at stage 1, stock is basically doing nothing. It's just going back and forth. It's sideways. It's almost dead, almost like it's not moving, right? And that's the area where hedge funds are accumulating, right? They're building a position. They're constantly buying under the radar, so nobody notices it. And then what happens typically? Stock either has great earnings, they had great news, stock finally breaks above that sideways base, and then we enter what's known as a stage 2. So stage 2 is an uptrending phase, also known as the demand phase. This is where everybody jumps into the stock, they start buying it, and the stock starts to uptrend, finally starts going up. This period is associated with lots of buying from greedy traders and investors, right? And stage 2 is when you get the best bang for your buck as a trader. That's where you get the biggest moves. And if you're buying and you're long a stock on stage 2, you can't really go wrong, right? Then typically what happens? Stock gets ahead of itself, it gets really extended, and then it starts to chop around, it starts to go sideways again. This is called the supply phase or the distribution phase, right? This is also typically sideways and a little bit choppy, and that's kind of the phase where now hedge funds are starting to get out of the stock. They start selling it, and then we get ready for what's known as a stage 4. This is a downtrend phase, also known as a supply stage as well, where now they're actively selling the stock and driving the prices down. So what does that look like on the chart? Here you can visually see, what stages would look like. You can see how the stage one is like choppy. It's going back and forth sideways on a stage one. Then we enter stage two, stocks finally starts to uptrend, and then we go sideways again, and then we roll over again and start entering a stage four where the prices start to go down. What are the emotions now associated with these stages? Stage one is the accumulation phase or the apathy phase, right? Nobody cares about the stock. It's not in the news. Nobody's talking about it. And then it finally starts to uptrend, enter stage two. This is where you'll see news articles about the stock. Everybody's tweeting about it. Everybody's talking about it, right? That's the stage two. And then the momentum slows down. The buying slows down. Stock starts to go sideways again. And then finally rolls over into stage four. And every single stock will repeat this cycle over and over. Now you might be thinking, Anmol, if all the stocks repeat the same cycle, how do they ever continue to go up if they just keep repeating this bell curve pattern? Well, that's because the bell curve might not always come all the way back down, right? It might create higher highs and higher lows, which you'll see over into the next slide. How do we actually trade these market stages? So take a look. Stage one here, stock is going sideways. Then typically after the sideways base, we get what's known as a breakout, where the stock finally breaks out, and that is the time we're looking to buy. We're looking to buy that breakout above that sideways base. And then after breaking out, stocks will pull back typically to that area where it broke out from, and it gives us what we talk about as a buy setup. So in that position, again, we're looking to buy that stock. We're looking to buy that pullback. And if it's correctly picked a stage two, then the stock is just consistently going to go up and create an uptrend. Now, after it's made like 3 to 5 moves on the uptrend, that's where you typically know, okay, the momentum is going to start to slow down. Now, how do we distinguish between what's a stage one sideways and a stage three sideways? Great question. Glad you asked. So in stage one, it's typically going to be very narrow ranges, and stock is just very tightly going sideways. Whereas in a stage three sideways, it's going to be wide and whippy. It's going to be like back and forth choppy and going to have potentially big ranges. But all the stocks repeat this over and over. Now, why do stocks do that? Well, because stocks only move on two primary emotions, fear and greed, right? All human emotions are the same. And we can see those human emotions on this chart. So now I'm going to show you rapid fire back to back a bunch of different stocks that all have the exact same pattern. Now, once you see this, you can never unsee it, right? It's almost like learning a new language. You start learning a new language, somebody start talking in Russian, and you're like, I don't know what he's saying. And then you spend like 2 years on Duolingo, or you take some lessons, you learn the Russian language. Now suddenly you understand it, right? So now as you see these chart patterns on different stocks I'm going to show you, you can never unsee it, all right? So here's a chart of Zoom communication. Look at this over here. Stock starts to go sideways from April, right? And suddenly it breaks out above that sideways base in 2020. Stock starts to trend up, and look at that, beautiful uptrend. Then what happens? Stock gets extended. It's get ahead of itself. Guess what happens then? We start to get another sideways move, wide and whippy. Stock finally breaks under the moving averages, and then we enter a stage four downtrend. Stock goes all the way back down again. And then look what's happening now. Zoom starts to go sideways yet again. That already tells us it's back in an accumulation phase, and it's likely to go back up and repeat this cycle over and over and over again. Here's another chart. Now, this is a chart of Roku, R-O-K-U, Roku. You will notice the exact same pattern. Notice this bell curve. Do you see the bell curve pattern? We showed you in the previous slide, the stages of the market. Notice how Roku did the exact same pattern. Sideways, then enters an uptrend, stage two, gets a little bit choppy at the top, stage three, and then comes right back down, enter a stage four downtrend. And then guess what happens after? It goes sideways again. That's a stage one. And these patterns will repeat over and over and over again. Here's a chart of Peloton. Notice that, right? Exact same pattern. Sideways, breaks out, beautiful uptrend, gets a little bit choppy at the top, stock comes right back down, enters a stage four, and then goes sideways again, back in a stage one. So all these stocks, as I'm mentioning it, you might want to actually keep them on your watch list. You might want to actually add them to the watch list, because majority of the stocks that I'm going over now are in a stage one, which means what's going to come next? Take a guess. Well, stage two uptrend. So we're going to look for a breakout on these stocks too. Here's another chart. Spotify. Notice how Spotify was going sideways all the way from 2019 till 2020. Then the stock breaks out, enters an uptrend, starts to go sideways again, breaks below the moving averages, and then guess what happened? Stock goes all the way back down, and then guess what it does? Comes all the way back up. See how these patterns repeat over and over and over again, right? And I'm going to keep going. I'm going to keep giving you more examples. Why? Well, because repetition is the second law of learning, right? The more you repeat, it'll ingrain into your mind. That's what's called pattern recognition. right? The only difference between you and I as traders is I've just seen more charts than anybody else, right? Been doing this since 2010, 15 years now, all right? And for the first 5 years, oh, I would spend all day. I had zero friends. I'd literally spend all day on computer looking at these chart patterns, and that's how I was able to spot a lot of these things that I'm going to share with you right now. So I'm going to keep repeating this pattern, showing you all these different examples so that you finally get that repetition and you get that pattern recognition. And then your goal after this video is to continue to do it on your own end. Try to spot these patterns that I'm going over. All right. Here's a chart of Tesla. So Tesla went, completely going sideways all the way from 2017 to 2020, completely sideways stock. 2020 stock breaks out, enters a beautiful stage two uptrend. I notice at the top how it gets whippy again. Then the stock finally comes all the way back down to a stage four. Then it starts to create a wedge pattern. Stock breaks out again. And you all know what happened after that. Let's take a look. When the stock finally broke above the wedge pattern, look at that. It went straight into $470. But then what happened? Why did it come down after 470? Well, because the cycle has to repeat itself. Nothing goes up in a straight line. Nothing goes down in a straight line. Market moves in ebbs and flows, and that's what the markets do. So Tesla is doing the same thing. And you can see here, I took a beautiful trade here. I had 1,600 shares of Tesla for a trade. I took this beautiful breakout, and look at that. Beautiful breakout. There's a six-figure trade. It's really awesome. Now, you might say, but what about Bitcoin? Bitcoin only goes up, right? Well, even Bitcoin, do you guys remember when it went to 20,000 for the first time? It came all the way back down to 4,000. And then it went back up again to 60,000. But then guess what happened? It came back to 15,000. And for 15,000, it went to 72,000, right? And then it pulled back to 52,000. So these cycles, as you can see, repeat over and over and over again. Bitcoin goes sideways, breaks out, gets ahead of itself, stock pulls all the way back down. Now here's a chart of Netflix. Look at the same thing. Netflix is beautifully uptrending, gets ahead of itself, pulls all the way back down, and guess what? It comes all the way back up. Right? These cycles, again, remember the bell curve. Put this picture in your mind so that next time you're seeing it, you know which stage the stock is in. Next slide, Palantir, PLTR. Stock gets on IPO, going sideways here, breaks out, goes straight into an uptrend, comes right back down all the way, goes sideways again, then it breaks out yet again, goes back to 38. Here's a chart of Solar Edge. Same exact thing, guys. Do you guys get the picture now? Right? I think you guys get the picture, right? Sideways, stock goes back up again. Look what happened here. Wide and whippy distribution phase. Stock enters a massive stage for decline. But guess what? Solar Edge now is back into a stage one. Put it on your watch list. The stock could easily come back to $80, $100 a share in the next couple of years. So again, put that on your watch list. Here's a chart of Teladoc, TDOC. Teladoc, again, exact same pattern. Sideways, uptrend, distribution, back down, sideways again. Potentially will go back. Now, this is how I personally beat the market. If you just buy in the right stages, even if you're not a great trader, even if you're not a great investor, if you just buy in the right stage and get out at the right stage, you're going to be ahead of 90% of people. Remember websites like Motley Fool and all these other investment recommendation websites? They were recommending to buy Teladoc at $250 a share, $280 a share. The exact stages where I was selling it and hedge funds were selling it, right? Now that stock from $260 a share is trading at like $8 or $10 a share. That's a pretty massive decline, 90% plus decline on your investment. If you're just doing the traditional approach of buy and hold, which for most people is buy and hope, you're lost 90% of your investment. Whereas if you knew that, okay, stock is entering a decline phase, I'm not going to buy it in the decline phase. And if I do have it, I'm going to sell it. Here's a chart of Lending Tree. Look at this stock. You guys get the picture now, right? Right? If I go back and forth between these slides, it's the exact same pattern repeating over and over and over again. Lending Tree stock went from $420 a share down to less than $20 a share, 90% plus decline. And most people were buying the stock in the $200s, $300, even $400 range. And people were recommending it online. If you went on Reddit, if you went on X, people were saying, buy the stock, it's going to go to 1,000. But they didn't know what you know now, which is the market stage method. And look how the stocks came all the way back down. And always imagine the bell curve. Where in the bell curve are you? Here's the chart of DocuSign. Just look at the chart, self-explanatory. Exact same thing we've been going over the last 20 slides. I'm going to keep going. Here's a chart of bonds, right? We went over a lot of stocks. Here's a chart of treasury bonds. Same exact pattern. Now, how do I use this, Anmol, on day trading. You showed me all these charts that are like daily, weekly, monthly charts. That's great for swing trading, but I'm only a day trader. How do I use this? Well, find the same pattern, but drill down. Do it on a 5-minute chart. Do it on a 60-minute chart. So here's an example. Here's a 60-minute chart of a stock. You notice the stock is in a stage 4 downtrend. Are we going to buy in the stage 4 downtrend? No. We're going to look to short in the stage 4 downtrend. But then look what happens. Stock at some point stops going down and then starts going sideways, right? So we know, okay, now it's going sideways, and the previous stage was stage 4 where it dropped, and now it's going sideways. So after stage 4 comes what? Stage 1. So that's how you know it's stage 1. Then you see what happens. Stock breaks above that sideways, and now we enter a stage 2, and the stock goes back up. And this is on a 60-minute chart. So you could absolutely day trade that. Now notice the relationship to the moving average to the trend. Notice that, right? In a downtrend, the price is typically going to be below the moving average. And this is about a 20-period moving average. The stock stays below the 21-period moving average and continuously goes down. That's how we know it's a downtrend, because the moving average is sloping down. Then what happens in a stage 1? The moving average stops going down and suddenly starts going sideways. As the stock breaks out above the sideways base, look what happens. The moving average starts to curl back up and the price stays above the moving average. So just by looking at the moving average in relation to the price of the stock, you can kind of already tell which stage the stock is going to be in. Another example, which is also a 60-minute chart, notice the exact same thing. Stock sells off. Where's the price? Below the moving average. What's the moving average doing? It's sloping down. Then what happens? Stock stops going down and starts going sideways. What's happening to the moving average? Moving average is going sideways too, right? And the price is going to crisscross above and below the moving average. Then what happens? Stock breaks out above the sideways base. What happens then? Look at that. Price stays above the moving average and the price starts to trend higher. Now here's the exact same thing, but on a monthly chart. Monthly chart is suitable for investors, long-term traders, and core traders. Notice the same thing. Price is where? Above the moving average. Where's the moving average? It's trending higher. What happens in a stage 3? Same exact thing. Crisscrossy pattern. Moving averages go flat. When the price breaks below the moving average, breaks under the support, that's your signal as an investor to get out of the trade, or as a trader to short that stock. Now where's the price now? It's below the moving average. What's moving average doing? It's going down. So now we know it's in a stage 4. Now notice what's happening here. Quiet stage 1. Price is going sideways again. Moving average is flattening out. So what are we going to look to do? We're going to look to buy the breakout above that sideways base. Now notice the difference between a stage 1 sideways, how choppy sideways it is, and notice the difference between a stage 3 sideways, back and forth, choppy price action going on. Now this is for you day traders out there, for you scalpers who trade like on a 1-minute chart, 2-minute chart, right? Really active trading style. Now notice the same thing. This is a 1-minute chart. Look at what the stock is doing. Sideways stage 1. Stock breaks out, goes in an uptrend, stage 2. And then what happens? Stock gets extended away from its moving average. That is when the supply is increasing. When you start seeing these tails, that's your signal that supply is increasing. The sellers are coming back. Guess what happens then? Stock breaks down, enters a stage 4 downtrend, and what happens after? Stage 1 sideways again, then stock starts to go back up in a stage 2. So this is the same exact pattern, but now on a 1-minute chart. But do you see the same bell curve that we're talking about? Same thing will happen over and over again. Now here's an example from a day trade that I took in the chat room live in front of our members, right? So you notice this is a chart of Newsmax. This is a new stock that just came out. This is on a 65-minute chart. So notice what stage the stock was in. It's in a massive stage 2. Then we get these tails coming in. We know it's about stage 3. What happens then? Stock goes into a stage 4. And then on this day, I saw this stock starting to go sideways yet again and holding like a double bottom support. So that's the day I said, okay, I'm going to go down to like a 5-minute chart and try to find a day trade on it. So I'm seeing the stock is double bottoming on the 60-minute chart. It's in a stage 1. It might start to go higher. And I drill down on a 5-minute chart and I take this breakout entry. As you can see, these are the live call screenshots from our chat room. Newsmax pops up and I get out for a beautiful trade there on Newsmax. This trade was done on a morning breakout on a change of trend. How did I know that change of trend? Look at the 5-minute chart again. Notice how the stock is going down here. Suddenly what happens? It stops going down. It's going sideways now. Breaks above the sideways. We know what comes next. That's the stage 2. Stock spikes back up. right? So the same pattern repeats over and over and over again. And this is the exact same strategy that I've used in my own trading account, whether I'm day trading, whether I'm swing trading, whether I'm long-term investing. And that's how I've beat the market year after year. So this is a screenshot of my own brokerage account, right? You'll see this is my results from 2023, basically 2023 November till 2024 for about a 1 year's worth of returns. And this isn't even the updated slide. It's actually much better than that now. But you can see here, if you just put your money in the market, right? The green line is the S&P 500. The yellow line is the NASDAQ QQQ. And then this red line is if you put your money in gold. And the blue line is my trading account performance. You can see it's like way ahead of the market. We got over like 150% return, while the markets would have given you maybe 20, 30% year return. And I've used this exact same strategy to trade these markets. So now, where do you guys go from here? So here's the thing. We know the market repeats itself in 4 stages, right? Stage 1, sideways. Stage 2, uptrend. Stage 3, sideways, but much more vippy and choppy and a lot of tails. Then we enter stage 4, downtrend, right? Then after downtrend, stock will start to go quiet again. Nobody cares about the stock. It's pretty much dead. That's the base. That's called the accumulation phase. And then the stock starts to uptrend. Now, if you're a day trader or if you're a swing trader, again, look at all these patterns. Ask yourself the question, what stage am I in? Now, if you're somebody who's watching, you're like, I don't trade at all the stock market. I'm just an investor. Well, as an investor, then all you need to know, you don't need to pinpoint the exact bottom. This is the mistake a lot of people make is, how do I know that's the top? How do I know that's the bottom? Nobody cares. Nobody knows. I don't know what the top or what the bottom. But if I just buy it in the right stage, for example, if I'm clearly seeing a stock, it's in this point of the bell curve, it's going down, well, just don't buy it as an investment. It's going to keep going down, right? Same way, if the stock has already made a huge run up and now everybody's talking about buying Nvidia, well, don't buy it there either. You want to buy when the stock is just either getting started or at least just look at the bell curve and see where are we in the bell curve. If you're early enough in an uptrend, you're good enough to buy that stock long term, right? When it starts to roll over, try to look to get out. That's all you got to do. You don't have to pick the top. You don't have to pick the bottom. Just trade the basic meat of the move, right? The basic nutshell. If you buy it in the right stage, you can't go wrong. Because here's the thing with trading or investing. You and I could be in the exact same stock at the exact same time, but our returns are going to be vastly different. Based on what? Based on where we buy them, right? 10 of us could be in the Tesla at the exact same time. We all have Tesla in our account, but one person bought it at $400 a share. One person bought it at $200 a share. Even though we have the exact same stock in our portfolio, how we do overall, our returns are going to be different based on where we bought them. So if you just buy it correctly, selling it is even not that important. If you're somebody who trades or invests in his retirement account and you don't really want to sell because you're going to have to pay capital gains tax, so you just want to hold it so that your money grows tax free, well, then don't even worry about selling it, but just make sure when you buy something, you're buying it in a stage 1 or a stage 2. That's all you got to do. If you just buy them correctly, half your battle is done with trading or investing. How do you fail with this strategy? The only way you're going to fail with the strategy is if you completely ignore it, if you never execute on it, if you never actually apply it, right? Or I told you this strategy and you know the stock is in a downtrend phase, but Anmol, look at the news. The stock's going to come out with this amazing news tomorrow. Tesla's going to report robo-taxis. This drug is going to get approval. Or I think GameStop's going to go back up again because Roaring Kitty tweeted something. Then you're ignoring your technical rules. Because think about what you're doing then. You're ignoring what your eyes are literally seeing. You're seeing the stock is going down and it's in a downtrend phase and you expect it to magically just go up for you. Isn't that hope? Isn't that the same thing as hope? Isn't that the same thing as emotion? So then do you really have a plan of trading or are you just buying because you go an article? And that's the mistake people make is they can see this pattern now. I showed you tons of charts. You will all be able to spot it now, right? But the only way you can lose with the strategy if you ignore the rules. If you just trade based on what you're seeing online. But Anmol, that article, somebody said on Reddit, they're all buying it now. My friend told me to buy it. That's how most people end up losing. So don't ignore these rules because this is the foundational element that you're going to build on. You can learn all the advanced strategies in the world. They're not going to work if you're buying it in the wrong stage. As simple as that. And that's the biggest mistake that I'm seeing people make. Even in our community, in other communities, in YouTube, right? People are buying even the perfect pattern. You guys have watched so many lectures that Jared has done and I've done, and you might have even taken the courses and you wonder, Anmol, I took this trade. This was a perfect pattern. Why did it stop out? Here's why. Because you bought it on a 5-minute chart with a beautiful, perfect pattern, but the stock on a higher time frame is in a different downtrending stage. So even though on a micro time frame, you bought the perfect setup, but the stock is in a larger downtrend. So then what happens? Those breakouts fail. So a lot of the questions on YouTube comments people sent me was, I've been buying these breakouts, they're perfect patterns, they're just not working for me. They keep going up a little bit and then they come all the way back down. Because the higher time frame guys always wins. Think about it. Who has more money? Swing traders, investors, hedge fund managers, do they have more money, or do day traders have more money? Well, the answer is investors have more money, right? Hedge funds are trading billions of dollars. So are day traders going to move the market, or the hedge funds going to move the market? The person with the bigger money is going to move the market. So the higher time frame will always win. So the biggest mistake that I see a lot of traders make online is they don't match the stages. The best trades are when you match the trade on a 5 minute time frame to a larger stage. If a 5 minute time frame is in a stage two and the daily is in a stage two, that's considered a stage to stage match. Now your trades have a higher probability of working. But if on a 5 minute chart you buy the beautiful breakout because it's in a stage two, but the daily and the 60-minute chart is in a stage four, then there's no stage to stage match. That's where your losses are coming in from. So here's your homework for today. Actually, I don't like to call it homework. We'll call it a growth opportunity. Here's your opportunity to grow. Open up your chart, open up your investment account, go through all the stocks that you currently own, and I want you to write down in the comments what stocks you actually own in your portfolio and what stage do you guys think that are in. And I might read your comments and I might correct you if I see that you got the wrong stage. Okay, so post in the comments what stocks you own in your long-term account and what stage do you think they are in. Are they in stage two? If so, great, keep holding. Are they maybe entering stage three? Maybe decide to sell some, take some profits off the table. Or are they in a stage four? Well, they're likely not going to come back up, right? They got to finish the stage four and enter stage one before they can come back up. So ask yourself that question, right? And if you are day trading right now, go back and take a look at your last 30 day trades you took, the ones that didn't work. And notice, were the stages in alignment? Was the daily chart stage in alignment with the 5 minute start stage? Or was it not in alignment? And you're going to discover that majority of your losses come from you not matching the stages. There's no stage to stage match. So hopefully this video was helpful for you. You learned something there. Again, these are the foundational elements of trading, but without this, nothing works because you can learn all the advanced technical strategies and patterns, but you're going to still have these losses because you don't know the correct stages that your stocks are in. The best time for traders to trade, for me personally, is the stage one breakout. This is like my bread and butter swing trading strategy. I also call it the uppercut pattern. Why do I call it the uppercut? Well, because just imagine, right? What does the uppercut do? It goes from sideways to up. So it's like an easy way to remember that pattern in our chat room we use all the time is the uppercut pattern is just imagine, right? Take your fist here. What does it do? It goes sideways to up. So that's what the way the stocks go up. It always has to do a little bit sideways before it can start to go up. So notice that. And that's my bread and butter swing trading strategy. All I'll do all day long is go on a daily, weekly chart, find these stocks that are just dead sideways. Nobody cares about them. And as they start breaking out, I buy them. And as other people start buying it, right? Because now it's in the news because it's finally moving. Guess what I do? I follow the hedge funds. I start selling it to them. That's what we call in Wall Street feed the ducks. When the ducks are quacking, you feed the ducks. So when everybody else wants to buy GameStop, we sell it to them. When nobody wants to buy it, then we buy it from them, right? So you rinse and repeat the strategy and over and over. So go out and execute the strategy, make it happen.